Welcome back, everybody. I hope you're all doing good. So, I thought that I would talk about rejection blocks and how I would utilize them in taking entries as well as using them in your analysis. But before we get to doing that, I want to talk about this dollar chart. We are looking at a daily chart of DXY. And if you followed the channel from quite early on, one of the first videos we did was a review video. And a couple of those videos posted, I talked about this specific analysis. Now, I haven't changed any of this stuff. I just logged in now on this specific trading view and came to look at this. So just looking at this chart, we had these all equal highs over here, which you can see these were now traded. Price grabbed the liquidity above them, and then it turned around. Gave a market structure shift down there, and the fair value gap would be right there. Traded back to it. You also had a breaker, high, higher, high. So your breaker block would be these down candles. That would be the breaker block, fair value gap. You also had a balanced price range. All coming together in one structure shift. 2022 model, there it is. Trade it down, you would target these equal lows, this fair value gap here, which would be in a discount. If you took a fib from low to high, that would be a discount. That would be your target on a daily time frame as a potential swing trader. So looking at this over here, we're looking at this specific level in here, which was a weekly fair value gap, and we also had the weekly order block up to this level over here. As you can see, we traded up to these levels, and is it not strange how price just hung around these levels for a couple of days, for at least a week? It just hung around this level. So that's why using the weekly time frame is really advantageous to your trading. It just gives you a view of higher time frame and where price really wants to go on in the long run. And you could also expect these levels where price would possibly get stuck and chop around this level. As you can see, we traded right through the level, which we would then take this fair value gap and it would become a inversion level, and we would then expect to see it trade back down into it, acting as a support, pushing price higher subsequently. We also traded down into this daily fair value gap. Let's just go back. There you can see it was there. We also had this order block down there. Traded right into those levels, found support there, and then we traded higher subsequently. We had weekly equal lows in there and in there. Traded through those, grabbed the liquidity grab, turned around, and then started running higher. Ran higher in here, ran back up to these equal highs. After taking these equal highs, price immediately turned around, gave you a clear market structure shift right over there. This could be an order block. You could have taken that. You could have taken the mean threshold. There would be a plethora of entry points looking at this fractal of price over here. So as we were trading back down again, these lower levels would still be relevant. You could extend these levels over here. and you can see price traded through this level. Once again, it would still be a inversion level. Price came back up, tested it. We had an order block sitting right over there. It just nearly missed that order block, and price subsequently started trading lower back to these weekly equal lows area, which we had over there. We can get rid of this, rid of this, rid of these lines, and we can extend this weekly order block level over there too. As downside targets, we had these guys over here, these levels. Now these levels would still be relevant. These were daily fair value gap levels. Fantastic. Let me just get this fixed. Yeah, let's get this fixed over here. I sometimes end up pressing the control button, and then instead of it being a line, I end up messing up the rectangle. So let's extend this rectangle, and that could have been a potential target. You also then had this low, which would also have liquidity below that, which you can see price came right below that, not by much, but enough to grab the liquidity, and that would have been your target or your terminus point if you took any entries in there, and you kind of if you were swing trading or holding the position, then that would have been your target. Extending the level again, we can see price hung around this level for quite a while. Price then came back up again inside of this and this order block, both relevant levels. You can see we had a balanced price range in there as well. Let's extend this. There we go. Look at the candle bodies. The candle bodies just respected this balanced price range. Candles just kind of wicked through and then eventually traded off. We also would have had a valid order block in here, which would have been this guy right there. You could have taken its mean threshold, which if I just eyeball that would have been around about there, which you can see the candle bodies respected that. Subsequently trading down lower, trading off lower, coming back into another order block over here, subsequent to down candles. Order block, look at that, bam, respected that level quite nicely. Looking at this level over here, it could have been used as a breaker block with higher high, but I like to see my breaker block levels having a bit more clear liquidity resting above them, like this one over here, which we could see we had this liquidity resting above it. I guess you could say these equal highs had liquidity resting above them, so price did grab liquidity over there, and it also took the liquidity out before we then started trading lower. So that would have been a valid breaker block. You can see that it traded that pretty perfectly, pretty spot on actually. And if you run a fib on that, and let's just get okay. Just look at the 50% on that. Look at how the candles just came stopped like a brick wall on the 50% of that breaker block. And then we just tanked, and obviously you have equal lows in here. You have a fair value gap there, and you have trend line liquidity. You got a bunch of trend line liquidity right there, which could have been used as targets. And then this is where these weekly fair value gap levels come into play. If we extend these levels, isn't that quite neat? Price just came right to that level and it froze in its tracks. It's currently retracing. It's reaching back above 50% for a premium array before it can continue its downtrend or then show us signs of reversal if it wants to reverse back above these equal highs over here. So that just gives you a little recap on what we were looking for and how eventually that price did trade to these levels. Look at that small little fair value gap right there. You can just probably zoom it in a little bit. See that small little fair value gap right there? Price eventually came right down to it, grabbed these equal lows, tons of liquidity resting below that, right into this level, and then we have a order block sitting right there as well, which it did not trade. Came right into the fair value gap, traded that, and then subsequently started trading. Retracing. We could go back up into these lows over here, acting as a mitigation block. And then we have this string of up candles, which is also a order block over here. We could get the mean threshold of that, and then it would kind of line up with this order block. And then we have this fair value gap as well, which we could get mean threshold of and look at those levels for our trading. So now we can get over to the subject. Yes, we also had levels up in here, which they also got traded in there. If I just bring this up again. Really, really sloppy price delivery, honestly. Very, very sloppy. Really choppy around this level. We were stuck at this level for quite some time. I remember that. Before we traded through this level and up and beyond. All right. Let's look at rejection blocks and how we can use them in our trading, as well as how we could take entries with rejection blocks. All right. So looking at this wick, that would be a rejection block. Hold on, let me just move this over one bar. There we go, rejection block. It right there. This candle traded down into it. It did not clear the low. So that would be a rejection block. Let's go ahead and work it down. See that? Boom, it just traded right into the wick. That would be a 4 hour. So 4 hour rejection. There we go, 4 hour rejection block. Let's move it over to this specific day. Let's work this down. Eastern Standard Times. So this would be a PM session looking at the 2 o'clock. It would fall somewhere in a PM session trading zone. PM trading. I just want to look at this to frame trade setups. So time is not as relevant. I just want to show the example here, how we could utilize this. So looking at this example and this trading idea, price came into this 4 hour rejection block. This should have been at the bottom. Text Put that at the bottom. Price traded into this. It rejected it. Let's measure that. See that 50%. Let me just make a crude depiction over here of consequent encroachment. Consequent encroachment level, and let's get rid of this fib. Let's just extend this a little bit. And working in the 5 minute, 3 minute, 1 minute, whatever you want to use as a entry model or whatever you trade. If you look at the 5 minute, then we have stops below here. Below here, we have like a trend line liquidity. We have stops there, a bunch of equal lows there. We have like a low right there. Price just slammed right through all of these ones over here. Grabbed the liquidity. We were bullish. If we just go back up to a 1 hour chart, then you would have expected bullish prices because of dollar pushing down lower. So you would have ideally been looking for bullish prices. Although it is possible to trade against the trend, some people just are contrarian traders. They just work against the trend, which that's perfectly fine. Just as a tip I'll throw in, if you're trading counter trend, then just cut your risk in half, because that, sometimes trading against the higher time frame, it just, it could equate into, losses or, unnecessary losses. So if you do trade, against the higher time frame trend specifically, just be sure to cut down your risk. Be aware that you're trading against the trend, and you have to journal those trades and see what types of returns, what types of data you get by trading like that. And you will eventually, if you are not somebody that trades with the trend but you trade against the trend and you're a contrarian, then that would be your approach. By trading against the trend, you just have to go and do the work and do your back testing and see what suits your personality. So looking at this setup, we have taken stops. So stops would have been taken. Well, just give me a sec over here. I just gotta find our handy dandy checklist. There we go. We have the little checklist over here. Now, just ignore London or New York session. That's just gonna be AM or PM. It doesn't matter, honestly. It's just AM, PM session. That's just how you note that you are trading inside of a relevant session. In this example, we are looking at an example that would relatively fall into the PM session. So we would, okay, I'll take down this box. Let's do a 5 minute trade setup, and then we can go down and do a 1 minute trade setup. So we can say, yes, it's inside of the session time because we would be trading the PM session. My full frame would be off of a higher time frame level. By the way, higher time frame levels are very important. They save you a ton of losses. And basing your lower time frame entries off of higher time frame levels or higher time frame stop hunts, that just increases your win rate or your strike rate accuracy by quite a lot. So it's very important to always go on a higher time frame, whether that be a 4 hour, a daily, or a weekly chart, and you can work it down from a top down analysis and bring that weekly down into a daily, bring the daily down into a 4-hour chart, and you can even bring it down lower than that into a 1 hour if you like. Ideally, to get a view of where price is going in the long run, just gives that oomph. The elephant stepping into the pool, it just gives you that volatility. It just makes your trade go. If, of course, you have the proper narrative as well as knowing where price is growing to. And then if you are on site, it just makes your trades move when you are on site and you are trading with the bigger boys. So looking at this setup, we will frame two entry models over here. The first one being price came into the rejection block of the higher time frame, which is this box. It tapped into the mean threshold. If you are more of a wild trader, then as soon as price taps into this level, goes away, it shows rejection. That could have been an entry right then and there. That would be a entry. Or you could wait for price to come down, trade into the consequent encroachment of the level, and then show you rejection in means of an up close candle, or sometimes price just wicks down like this, pulls up, and that shows rejection. So there's a couple of ways you could enter this position. Let's bring this up over here. So this would be a order block. That would be an order block. Price validates it by trading above it, comes back down into it, at the same time tapping into consequent encroachment. That would be a valid entry point. Your stop would have to be below the 4-hour rejection block. Like that. That gives you about a 5 handle stop. Now, you could also go and you can take this wick we have over here. And let's just see that? It just coincides with this consequent encroachment of the higher time frame. And this is not coincidental. That is not coincidental at all. It just shows you how algorithmic it is by just coinciding with that specific level. So you can do that as well. And that adds confluence to your trading idea. If you took this trade, then we can just look at this swing. We can load a high, we can measure that. You can see that we were in a very, very deep discount. So we can tick some more boxes over here and we can say that we stops attack, yes. And then if, for instance, we took the order block entry, in this case, or in this specific example over here, getting a market structure shift, you would be looking at this candlestick right over here. But it's quite difficult to see it in this example. So some of you might be looking at this high over here, and you can see we had tapped it right there. Boom. So it depends how you look at it though in this example. But I would say yes. We cleared this candlestick there. That would be a market structure shift. If not that one, then you can look at these candles over here. That would also be a valid structure shift. It just depends how you look at this piece of price action. So we have that. And then aggressive run, unless we trade above this one or above this structure shift, I would say no. There was not an aggressive run, but we shall get to those entry techniques. So aggressive run, no. Price in a discount or premium, yes. Fair value gap in a discount. Okay, fair value gap. In this example, you can change this fair value gap in the discount or premium. That could be an order block, which was in the 50% discount or premium range. So that order block would have been in a discount. So that would be a tick because the order block would be in a discount or premium range. Correct. So that's one idea to structure or formulate a long position, right? At this order block band rejection, you took it right there, stop below this low over here, and take profit. Looking at the 50%, you could have taken a take profit right in this gap. Right at this gap, you could have taken a partial. You could have targeted these equal highs, and you had this liquidity resting above here. It all depends on what you prefer. Each of us will prefer a different exit strategy. For example, some of us will take a fair value gap in the premium range, and that's ICT teaches that specific exit technique in his 2022 mentorship. Some of us prefer equal highs as an exit strategy because we know that there is liquidity resting above this area. Some of us prefer all highs or all lows as our exit points. But it's always a very good idea to take partials. Take partials along the way. Pay yourself something. In doing so, like ICT says, partials never ever fail. Partials pay every single time they pay. Price could only come up to this gap. It could just decide that it wants to reverse in this area and it could go down and take you out of this position. Then that would be a loss. But if you took a partial in this area, this would have been 20 handles in this case. And that would have been a very, very handsome payday. You could just take 50% off the position right here and then bring your stop to entry, break even. And that just takes the risk off of the table and you've paid yourself something. And when price gets above this area, you can close the whole position. Or you could take another partial and you could perhaps close the position above there. It just depends on what fits your personality and what fits your trading style. You have to incorporate these small little quirks that just work with your personality. These things that make sense to you, you have to incorporate them. You cannot force an idea, force something just because ICT said so, because I said so, because a different trader said something on Twitter. You have to go in, you have to sit down, you got to put in the work, and you got to see what works with you. There are certain things that are going to work with you, certain things are just not going to work. Your model will click. If you like fair value gap models, it will be super easy to see them. It'll just make sense for you to use that specific model. And you just have to go and you just have to use that specific model that works with you. Some of you might be using order blocks. If order blocks make sense, go use them. If breaker blocks make sense, then you use them. If volume imbalances make sense to you, then you use them. It just honestly, it depends on what makes sense to you. And that's what you're going to use. If you like incorporating the new week opening gap, then you incorporate the new week opening gap. If it just doesn't make sense to you, if you don't want to use it, then you do not use it. I couldn't care any less. If you want to use new day opening gap and it makes sense, then you use that. Like I've been I posted on Twitter that I've been quietly developing and quietly studying, and yeah, that's what that's what I've been doing. I've been doing a lot of just forward testing and just sitting there and watching price, and I'm testing my model. And if you guys remember, I said at 500 subs we are gonna start doing a weekly review, which unbelievably we're at 490, I think 491 or something like that subs. So we're pretty close now to the 500 now. I mean, it's around the corner. And I think what we'll do is I'll start posting on Twitter that weekly outlook as far as what I see for a weekly and I mentioned the pairs. I think it was dollar, I think the US 500. I'm not sure which other ones I mentioned, but I'll cover those ones. I'll be sure to post a weekly analysis, and as soon as price trades to the target, we will do like a little review on that, or an updated post on that. Or if price just does not trade to that specific area and price just does something completely different, then we will also do a review on that. As far as whether the review will be in a video or whether it will be a post, I am not 100% sure. I think that we will. It just depends on how price is going to trade to those specific levels, that it might be a video or that it's just going to be a post, a detailed post screenshot where we just explain that price traded to the expected levels, and or this is what happened. If, for instance, price did something different or it approached the level in a different way, then I think we will do a video. Otherwise, I think that we will probably just do a screenshot on those weekly outlook and weekly update videos, or weekly outlook on as far as analysis. We shall approach them as the time comes. We shall see what we want to do. Anyway, I'm diving off of the subject over here. This would be the first entry technique or trading idea. That would be your second partial or terminus, which you can see that's 30 handles, which is very handsome. A very fruitful session. All right. Now let's look at the second way I would approach this position. These two are going to be relevant. Still, stops will be traded PM session. Yes. Market structure shift. Yes. I'll explain why in a moment. So instead of looking at the order block, I will now look at a inversion level, which will be this little level over here, this little gap. So price trades through the gap, so we expect this to be a inversion level. We expect it to support price. By the way, this is okay. Well, I wouldn't use this one as a balanced price range because it traded it right over there and there. A balanced price range would be a level that is untraded. We will explain those in the future. That's just my thoughts now, me thinking out loud. But I would use this fair value gap as a inversion level, and this is why I say we have a market structure shift, because we shifted above these equal highs. So there you go, that's your market structure shift. Now look in this example over here, like sometimes we get a internal stop hunt where price just trades below this low and then it grabs the stops, trades into a level, and then we trade off higher. Targets would be, in this case, this equal high over there. That would be the first thing that jumps to my eye. I would take a partial right then and there. So again, we would have, yes, we had a massive aggressive run. We were in a discount, yes. And in this case, the gap would have been in a discount. Correct. We can see that right over there with a fib. So that's a second trading idea to approach this whole specific day. Let's just say it that way. And then after that, you can see price just completely died down because that's just out of the session. So this would be like a late PM session entry over there. And then it traded up, and that's it. You take your money off and you are done. Now I would like to go into the 1 minute and just have a look at the price action and discuss possible entry points on the 1 minute time frame. Let's see. Down here, let's go. So see how price just looks so much more just messy in this price action, honestly. It just really looks so much more messy, so much more gappy as well. Not clean at all. Being honest, I would not even want to trade in this. It's just very messy. Not clean at all. But for the purpose of this video, this down candle over here, price traded above it. We can even look at these consecutive down candles, but I'm using this one as the order block. Price traded above that, came back into it, and we can also look at the mean threshold of this candle. If you did take an entry right there because it rejected it, that's perfectly fine. Your stop would be below the 4-hour rejection block, which now the stop would be 10 handles. You can have a stop there. Again, take profits above 50%. We would look at this gap. That would be, honestly, this would be terminus for me as far as this trading idea. You could have taken this entry, you would have sat in some drawdown for 18 minutes before price eventually started moving. And we could look at this down candle over here. We could also look at this one. And you can see price traded above that, it traded back into it, and then we rallied up higher. That is the first scenario, how you would approach this one. Let's just look at let's say we took this entry over here, and the stop would be below there. You can see, there we go, 18 handles, not bad for a 10 pip stop. Honestly, I would not have taken this just because of how choppy it is, how gappy it is. It's not clean. I would not take that trade, in my opinion. I would probably have done something like going up to the 5 minute, and then I would note this gap. Note the gap. Go back down into a 1 minute time frame. There we go. I would have looked at something like this. This is how I would have framed the idea. We are below. There you go. AMP. Yes, stops attacked. Now in this case, yes, we attacked the stops to the left. Again, we had these stops in here, right? They got triggered, these ones. Okay, so stops attack. We had an aggressive price run. Yes, we did have an aggressive price run. Also, we had a market structure shift back there. We had that. Price in a premium discount. Yep, we were below 50%, so that would be a discount. And in this case, fair value gap. Yes. Gap would be in a discount of the range. Yes. This would be an inversion level, by the way. Price rating above it, through it, and then we expect support when we come back to this level. So looking at this idea, we would have as an entry point, you could take it on the rejection. In this area, stop would be below here. Framing this position, you would look at something probably like this. The stop would have to be below this area, 3.6. Take profit points. You have a partial in this area, right there, equal highs. That's 11 handles, which is not bad. And then I would have another one here and a terminus above this area, which you can see we just did not get up to this area. And remember, above 50%. So, these levels are quite adequate. I would take it all off over here, considering time of day. It did eventually meander up there, but I don't think you would want to sit through this. That's one approach. The second approach would be IOF, institutional order flow entry drill, which would be this gap over here, which would also be a balanced price range. You have a gap and a gap, and there's nothing that overlaps that gap. That would be, boom, right there, entry point. And you would have a stop right there, 1.8 handles. Yes, it reduces the risk a lot by using institutional order flow entry drills. But by trading with this, you will need a lot of back testing as well as notes in your journal to be able to do this. The average beginner trader might be doubting himself with this one, but practice makes perfect. So that's how you study and you learn and you grow trust in this specific model. So anyway, that could have been used as a gap entry. And there you go, 13 handles profit were made. So that's how you could just go on the chart, and you could be somebody that specifically looks for a rejection block to be traded. And then you frame your entries off of that higher time frame rejection block. Now, there's another entry over here. If you look at this wick, The wick would be a rejection block, correct? So if I put the box on there and I put the fib on there and I get the mean threshold of this level, of this candle, look at that. We traded this mean threshold and immediately we rejected this. So that would be another entry point right there, and the stop would be below the 5-minute gap. Again, take profit points above the highs. So that would be a rejection block entry specifically. You have to take the information. You have to go in your own charts. You got to go do your own studies. You just have to see what works and what does not work with you. You don't have to use each and every PD array that ICT gives you. You do not use all of them. That just sets you out for failure. You have to choose specific ones that work with you, and you have to take those ones and you got to go implement those specific ones, and you have to make one model and you have to stick with that specific model. And the only way you know if your model is good or not is that you have to go and you gotta go do back testing. You need check offs. You need to have check offs. You need to have a list of things that you check before you enter a position. There are things that you look for in the market before you even consider taking a trade. Specific conditions, specific news events, specific days, specific times. There are so many factors that come together before you look at even taking an entry. That's why many traders will tell you that having a model that's like the 10%. The 90% is time and what the market is doing, what news event is coming up, how is the current price action, how is the market behaving. Those things are 90% of trading, and 10% is taking an entry, looking at the model, taking an entry. That's 10%. That's the easy stuff. There's 90 different things, other things that you look at that will predetermine whether it would even be a good idea to take a position in the current market. What types of conditions do you have? Do you have conditions like this where it's gappy and spotty, choppy, not good? Or is price action clean and clear like this? I wouldn't trade in this. I won't trade in that. But looking at this, I would take an entry in this because it's clean, it's clear, it's easy to see the targets. That's where I would take an entry at. And there's so many ways to get into this specific position. I just showed you that we could take the rejection block. You could take a balanced price range. You could use a fair value gap. There are many ways to get into positions. The most important thing is that you know which market conditions to trade, which not to trade. When to sit still, when to be trading. Those are the most important things. Let's quickly talk about this post here. When I said we got 500 subs, I share my bias on DXY, EU, and US 500. That I think that's fair because DXY gives you a general idea what you would expect. If DXY is up, everything else is down, or if DXY is down, everything else is up. That is, of course, in a symmetrical market, you would get those conditions. And then US 500 and E-mini S&P, Nasdaq, Dow Jones, US 30. Most of these markets correlate. So if I see something clear on US 500, then you would be expecting a similar move in Nasdaq and US 30. You would expect something similar. If I do not find something clear on US 500, then I will switch over to Nasdaq or US 30. It just depends on which market is clean. Like at this moment, ICT is focusing on the Nasdaq because that's the clean market. That's the one that he is focusing on. So it will depend on what is clean, and from there on, you should be able to take the information and apply that to the pair that you specifically trade. Like I said, progressing through the week, we will review these levels once they get hit, or we will do a review if, for instance, price did not hit the levels and it did something else. We shall see. 2K subs. I will show you guys how to use the 2022 model and make an entry from rejection blocks, reclaim blocks, all the way to buy limits, buy stops, as well as the OTE to catch range. Now, this still stands that we will look at many different ways to form an entry point, many different ways how we can use different PD arrays to form a trading idea or come to a trading idea eventually on a lower time frame. I think that I've showed you how we could utilize rejection blocks today from a higher time frame point of view, how we could take those specific levels, how we could even enter on a rejection block in a lower time frame. Like ICT has said, not every PD array will be present in that specific piece of price action. You just have to wait until you get your specific PD array. If it's not present, then there is no trading idea. Then you sit on your hands, or you wait for the next macro, you wait for the next session, next day. Eventually you will get your macro. So I kind of showed you a little glance of this, but we will go into more depth with buy limits and then buy stops. We will specifically do that when we get to 2K. So we'll be holding back on those ones. Then basic rules. That's a very, very important point. That's where I talked about the 90% of trading comes before you even consider taking a position. So there are specific checklists, things that we will look at before you even consider taking a trade. We will get to using that, and different entry techniques, different tools. I'll kind of be building one or two models, and I'll be sharing those models with the community. So we'll kind of use different tools, some stuff from ICT's core content videos. We'll be using some of those things. We'll kind of be looking at all of those things, and I'll just show you how you can take that stuff and you can kind of make a model or two models, and you can implement those. I've already given one or two different models, and ways of entering positions and coming to a trading idea. So if we've kind of done that in a way, but we will then lay it out in more detail and specific. I've written down models for you guys. Again, after doing that, you will be able to make a solid trading plan, because we will be doing those pre-checks, pre-market checks. And then you have specific checks what that you do while you before you take a trade, and that will be that. As far as the group or the people who are interested in the subscription group, so let's before we close this video off, this live meeting, this is still something that we will most definitely do in the future. Once the channel grows, once the Twitter grows, once more people become involved, and as time progresses, I do want to give my approach or my way to the community. This will be my way to kind of give back to the community, to people, and just helping people in general. So in this meeting, once again, like I said, my personal checklist, pre-trade and pre-market checks, which I will share with you then. My personal approach to risk management, that we will cover that, how I specifically go in and how I manage risk on a position, how I know a position is still valid. That topic covers a broad spectrum of subtopics, which will be very helpful. And then how to backtest and journal it on Notion. I sort of have touched on this subject, but I have not quite done that in the extent of detail, which I will do that in the meeting or in the meetings group for the people that registers for this. Now this will just be a simple, it could be a Zoom, it could be a Teams meeting. It just depends on how many participants we have. But if we do eventually get our participants, I believe that it will be limited to a very small group of like 10 at a time or something like this until those people have gone through the whole course of what I want to cover with these people. And then we will open it back up again and take 10 more people and then cover through with them, and so on so forth. But these people will be on an exclusive group on, it might be Telegram. If we do in the future create a Discord, then perhaps that will be on Discord and it will be on those platforms. We will also be doing live streams specifically tailored to these with the people on this group. We will do specific live stream videos for these people. We will cover specific questions and topics that these specific people have. Those will be videos only for the members of this group. And then we will be doing the weekly outlooks and reviews. Those will be public on the channel. The outlook and reviews on price, I did talk about this. So it will be $30 for that subscription, where you will go in the group and where we then will start doing the checks and the approaches and how to backtest. Once I've covered those topics, then any questions obviously that you have or things that you request, those will then be covered in videos or in meetings or whatso be required. We shall cover those then. The payment options will be done from Skrill. I believe that we could possibly use PayPal as well. And then just a regular bank wire transfer. What I eventually will do is I am planning on doing live streams eventually, but I've not gotten to the point yet where we're busy with this mentorship still, and that takes up quite a lot of time. And then I'm kind of, being busy with my own studies as well, and my own back testings, my own forward testing. So my own forward testing, that kind of takes up a lot of the time with the live streams, and so eventually I will start doing live streams, and I will just include you guys into the videos, and we can do the live streams forward testing together. But I will just not be specifically covering my checklists on the free live streams for the channel. Those will only be on the specific live streams where some days the community group will sit together and we will do a live stream for specifically those members, where we will be more advanced, more free to talk about those things. So we will do that eventually. So that is still open. I believe that 30 US dollars is a fair price, as some of the more other people on Twitter host their groups. Well, I wouldn't even say groups, the one-to-ones that they have on covering specific things, and that's upwards of 150 bucks, whatever, for that mentorship, that specific session that he wants to host with the people. I think this is fair, and I don't believe that we would be asking more than 30 bucks, regardless of whatever time in the future comes, because I don't care about this money. It's just that I don't think that it would be fair to give my time doing these things in detail and preparing these sessions and those videos, and then you're just giving it out for free. I just don't think that's fair to do this. So I think that's fair to say that we can charge 30 US dollars for that, and that's just you paying me for the time that I invest to give you those materials and those contents. And of course, when you're in the group, there will be more things as things come up, and as I feel like I want to share more things, then we shall add to the list, and I will share with you guys what I feel fit, what I feel like I should share, what comes to mind, and we will just take it from there. But that's all that I wanted to cover, I believe. So I've been quiet for a while, but I've been quite busy. I've been working on my own things, and we've been on the mentorship of ICT. That's been taking up a whole bunch of time. My forward testing has been taking up time too. That's why I haven't been really doing live streams honestly yet. And I hope you all have a good day further, and then until next time, I hope you stay safe.